All right, ladies and gentlemen, I hope you're ready. Last week was absolutely insane with the carry trade fiasco. This week, it's going to be all about rates because we'll be getting the CPI. And now the question of whether or not the volatility is over. By the end of this week, you may not have an answer, but you should be able to experience it. So, Chad, we got a lot to go over. I have the plays. I have the keys. All that good stuff. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we're live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning. But before I tell you to run it, we're going to start with the question of the day. If you did not know what happened last week, we have a video titled on this channel, The Carry Trade Explained. That will give you a little bit of an answer there, but if you really want to understand, this is something I want to start off this week with, because what we are about to get after this big data with the CPI, we have to watch out for a lot of things moving forward between now and the end of the quarter, because what happened last week, it was a credit event. So if you're asking the question of whether or not last week was a big deal, yes, it was. It was one for the history books. Are people going to calm down about it this week? Yes, they are. If you don't even know how last week played out, long story short, it was July 31st. The Bank of Japan said, quote, the bank will continue to raise the policy interest rate going forward. And 8 days later, by August 8th, they said the bank will not raise their policy rate when markets are unstable. So this is what has people feeling a little bit better. If you even look at the SPY chart, even if you go look at the Japanese markets from the end of last week, they all started to recover. People started to feel good, and we kind of put the carry trade genie in the bottle. But what you saw last week, it was literally one of the biggest up and down days for the Japanese market ever in history. And then on top of it, for the carry trade, if you go look at any of the carry trade currencies and look at them over the last like 2 decades here, what you had last week was one of the biggest moves, top 4 moves. The only other time the carry trade, the yen, the dollar, and all these other currencies, especially the more safer ones, move like this, it was March of 2020, October 2008, and August 2007. So that's a big thing I want you to notice. But then the other chart, and this is the main thing of why I'm starting out with this, because I want you to realize what happened last week. Whether or not we get more of it, we will be seeing even tonight, whether the after hours goes crazy. That's what happened to our markets last week when we all started freaking out. Remember, everything was fine, and then it was the after hours Sunday night where everybody woke up, and then we woke up in pain and death and destruction on Monday. That's what we're going to be watching for this week. But in general, I want you to understand what just occurred. It truly was a credit event. So what I have here is a bunch of credit events over the last couple of decades here since the early 2000s. And what it is showing you is the inflows before the event. That's here on top. And then the inflows afterwards. So every +1 is pretty much a week. And you're looking 3 months out, 12 weeks later. And that's why I'm saying now what just happened here. It may seem like the story's over, and maybe it is. We're probably going to get a lot more updates moving forward. But now what you want to watch out for the next 12 weeks, does what you see that got disrupted, does that change the inflows and outflows? And this is what I'm saying here, whether you like it or not, whether you think it's a big deal or not, the movements we got on the carry trade, the currencies, all of this stuff, this is just highlighting that something came out of the bottle last week, and now we will be watching this close over the next couple of weeks to see the true effect of the data and what this is going to mean. So I'd watch out for that. But now the best part is leading into this week now, we have bigger data, and there is another part of this story. I guess we got to jump back. That started all of this downside. It was one thing about Japan. Again, this was last week. Remember, that Sunday and how we woke up was absolutely disgusting, but there is another factor now, and that's what we're going to deal this week, and that is what happens when we cut rates. So, Chad, we got a lot to go over. I hope this all helps you out. I hope you're excited because, again, last week was crazy, and I do think this whole month is going to be a lot of pops and drops. So I hope you're locked in, but we have a lot to go over this week. I have the plays, the keys, all that stuff. What I need from you, a thumbs up on the video. Make sure you're subscribed. And I already told you we're live and all that. So run it, baby.
Walking to the couch, it's the joints on the legs. Live in the hills, but still get a spread. Started with a live, but it's still reinvention. Feel how I feel, then you feel like it's a blessing. I just want the leg. lesson. I just want protection. I'm up and I'm down, but the sound like progression. Mama never plans if he waits for perfection. Finger to the down, hold it.
But right off the bat, like I said, there's a lot that we're going to be dealing with this week with all of the data, but hopefully you're getting why I started with that other factor, because the volatility is out of the bag right now. Last week was Pandora's box. It was one thing about the Bank of Japan. It's not going to be over, and now we have to monitor how people feel about the economy, the soft landing, and all of that, and that's why this week is going to be so big. So it's going to be one part about the economy, the other part about Japan for tonight. We'll see every day if there's either more hawkish or dovish or something happens or nothing happens in Japan. That'll be one part of the story this whole week, and then the other part of the story, it's going to be how the data comes in and what that means for rates. So we're going to be getting the PPI on Tuesday, the CPI on Wednesday, literally inflation. That's one of the most important sets of data here. If that comes in lower, people are going to like it. If that comes in higher, people aren't going to like it. And remember why. This is what we were talking about while we've been talking the whole Japan stuff. The other part is, do we see the data slow down or deteriorate while the Fed is cutting rates? That'll determine whether a panic, surprise, unscheduled rate cut or not. That'll determine whether or not it'll be good or bad for the economy. So that's what we're going to be watching out for with the data. But now the big question here with data, if you haven't noticed, it's not about if or when. People aren't like, oh, is the Fed going to cut rates? No, we're settled on that. They're like, oh, when's it going to happen? Is it going to happen in September, in December? No, we're not worried about that. If you pay attention to what's going on right now, the debate that's happening, and depending on where the data comes in at, the next question people are going to be asking is, will it work? In reference to the rate cuts, they're saying, will the rate cuts work if the Powell's behind? Probably not. If he's ahead of it, then yes, they will. These are the things now the market is looking for. So keep that in mind. I think it's a very, very big deal. But for this week, it's going to be juggling the economic data and how it applies to this whole will it work aspect of the rates. And then we'll see if Japan ends up being a problem. So watch out for that. And just don't forget the main data sets, Tuesday, Wednesday, PPI, and then CPI on Wednesday. You will be getting a couple more earnings. There's going to be like Home Depot and Alibaba, and some of those are good, but it's really going to be all about that data. CPI will be the biggest set of data. There will be a couple of Fed speakers, but CPI should be your major set of data ahead of Jackson Hole on August 23rd. So right now it's like, August 11th. Get through this week here pretty much for the next week and a half. This will probably be your most important set of data. So watch out for that. And then finally, coming into key number 3, I think this was a big thing of last week. One, how crazy and volatile it really got. I'm telling you, even when I made the watch list last week on Sunday, things weren't that bad. Out of nowhere, a couple hours into the Japanese session, it got really bad, and we woke up down 6%. I'm showing you that currency chart there and trying to show you, the last time the carry trade even blew up like that, it was either 2020 or 2007. What we saw last Monday, I'm telling you, we have not seen anything like that. The VIX above 70 and watching about to be a limit down and watching all of that happen without somebody not blowing up, that's what we haven't seen. So it's wild that we're 1 week out of this, market already recovered, and then we're waiting for the next step here. So what I'm trying to say is that you saw how crazy and quickly things got nuts out of nowhere and the moves were big, but then also too, by Friday, you barely moved. And I think it was a reminder of how liquidity is both still low, but now that Pandora's box and these 2% every day, it might be a thing until we could lay to rest some of the things that opened up all of this volatility. So watch out for that, but it should be a very exciting week, whether it's plays or not. The data is going to be there, and it's firmly getting us ready to wrap up summer with a bang. So Chad, I hope you're ready, but let us get into the plays. So, right off the bat, I have a couple of plays, and before I get into any plays, I was saying this on the live. I was even saying this while we were live on stream and even on the live watch list. I'm going to give you guys plays on these watch lists, but I'm telling you, with how the yield curve has been looking, the fact we're getting some of these movements and even the carry trade in the yen and a lot of these things coming back to life, I like a lot of other plays, but I don't like what I'm trying to say is I'm going to post plays here every single day for you, but I really think you should be focusing on the bonds, the yen, and some of these broader plays, or at the very least, here has been the number one thing I've been saying here, newsflash, Earnings is in a couple more months from here, but so is the election and the first rate cuts after a couple of years in a big policy shift. So if you want to make a play, what I'm saying is kind of have a timeline that accounts for these next couple of months. Even if you're going to get an option play, make sure it gets a lot of time because these next 3 months are about to be very, very big events. So if you are going to make any short-term plays, I'm still all about the long-term, but any short-term plays, I'm just saying get more bang for your buck. And that's why I'm saying bond, yen plays, stuff related to the macro. I think those are a better sense of where you should be putting your money than kind of all over the place. But that being said, I still do have plays, but I'm giving you that disclaimer there to kind of caution against them. But as far as play number 1, DJT, Tesla, and even the weed stocks, but I'm putting this up here because there's an interview tomorrow with Donald Trump and Elon. But why I'm saying all of these, because last week we were watching that Donald Trump rally thing or whatever, and then the weed stocks went crazy. I'm surprised, but I've been seeing a couple of these, weed election headlines moving things. It's been a while since we saw the weed stocks move, so watch out on Monday. See if we get a political move. I have no exposure to any of these, but I want to see the fact that the weed stocks had such an epic move last week. Maybe this comes back to life again, so watch out for that. That is play number 1. Then play number 2, TLT and ZB, baby. I think it's going to be a very active week. Again, CPI, PPI, both of these move the bonds very big, and I don't have a play, but I did make a move on this on Friday. But here's the deal. This is how I'm looking at it. If there's a big move ahead of Wednesday and you see the bonds flush out or they run up, I would just go the opposite move ahead of the data. That's going to be an idea that I have, but don't go too big. And if anything, if you don't get a big move prior to the data, I would play very, very small and lean towards the options, because if you don't move big ahead of the data, that means after the data, there's going to be a wild move. And don't forget, the bonds have really been up a lot over the last couple of weeks here. So made a play on Friday, got out of it. It was like $30 or break even there, so it's still kind of high there. It's around that entry price we were talking about from the last couple of days. But I'm going to see here again, PPI, CPI, that's the catalyst, and then in general this whole range of 4 to 3.5 or 4 to 3.7 and 3.7 to 3.5 on the 10-year. That's something I'm going to keep in mind with the bond flips until the curve uninverts, and then we can make a big one. So watch out for that. That is play number 2. And then finally, play number 3, baby, Alibaba. So they have earnings this week, and honestly, with everything going on with Japan, even America, I think that U.S. is at a very key spot. So Baba specifically, they have the earnings catalyst. If there really is not too big of a move, we may go for the pre-earnings, but even in general, if they do good afterwards and then some of the story in Japan and all of that can level itself out. Remember, if Japan starts making a shift and so does America, this will be a good time to shift in China. And so far, last like 3-4 years, all they've done is bad, so their next shift would be to the upside. So gonna be watching out for that. But those are the main plays. As far as everything else, didn't make too many plays last week. We had good plays on oil, and then even a little bit there on bonds. The bond play was actually a little bit smaller than the oil ones, but I will be keeping an eye out for oil and bonds this week. But oil, yen, any of those plays will probably be the big deciders. Maybe a couple of plays on the post earnings, but I do think we're going to still be talking a lot of bonds in yen this week. This time it's going to be talking a lot of bonds related to the data, and then the week after that might be a convergence of both the bond and the yen. So we'll see where it all takes us. But Chad, it's time for an economic lesson, baby. We are on the balance of payments. So again, last week we kind of had to slow down with the world was writing its own history book. So now we could get back into it. We got some time here today, but the balance of payments is an accounting device that records all international transactions between a particular country and the rest of the world for a given period. For instance, anytime an American business exports or imports a product, the value of that transaction is recorded in the U.S. balance of payments. Anytime an American resident, business, or government loans funds to a foreigner or borrows funds from a foreign financial institution, the value of that transaction is recorded. All of the government's international transactions are also recorded. When the U.S. government sends money in Iraq supporting the military or provides foreign aid to Egypt, these payments are recorded in the balance of payments. By recording all such transactions, the balance of payments provides an aggregate picture of the international transactions the United States conducts in a given year. So literally, balance of payments, a recording of all transaction, loans, purchases, buy, sell, everything you buy and sell, even aid to another country, it is recorded. Again, you are balancing all of your payments. Continuing, Table 10.1 presents the U.S. balance of payments for 2020, the latest year for which the complete data is currently available. The transactions are divided into two broad categories, the current account and the financial account. The current account records all current non-financial transactions between American residents and the rest of the world. These current transactions are divided into four subcategories. The trade account registers imports and exports of goods, including manufactured items and agriculture products. The service account registers imports and exports of service sector activities such as banking, services, insurance, consulting, transportation, tourism, and construction. The income account registers all payments into and out of the United States in connection with royalty, licensing, fees, interest, payments, and profits. So hopefully you're seeing the different types of transactions. There's like goods and manufacturing. Those are like items. Then there's services. And then like, again, that's like insurance, banking, financial stuff. And then there's making money off of making money. Again, interest, royalties, some of the more intangible ways. So there's different types of trades that occur, but all of them are recorded. And again, that's all the current account. The financial account registers capital flows between the United States and the rest of the world. Anytime an American resident purchases a financial asset, a foreign stock, a bond, or a factory in another country, this expenditure is registered as an acquisition or capital outflow. Each time a foreigner purchases an American financial asset, the expenditure is registered as a liability or capital inflow. Capital outflows, assets, are registered as negative items, and capital inflows, liabilities, are registered as positive items in the capital account. In 2020, American residents other than the U.S. government purchased about $809 billion worth of foreign financial assets, whereas foreigners, including foreign governments, purchased about $1,456 billion of American financial assets. Capital outflows are set against capital inflows to produce a capital account balance. In 2020, the U.S. financial account balance was approximately $647 billion. To calculate the overall balance of payments position, simply add the current account to the capital account together. In 2020, the United States ran an overall balance of payment imbalance of $31 billion. The current and capital account must be mirror images of each other. That is, if a country has a current account deficit, it must have a capital account surplus. Conversely, a country has a current account surplus, it must have a capital account deficit. Grasping why this relationship must exist is easiest in the case of a country with a current account deficit. Having a current account deficit means that the country's total expenditures in a given year, all of the money spent on goods and services and on investments in factories and houses, are larger than its total income in that year. The U.S. case is instructive. American consumers spent about a combined total of $14 trillion in 2020. The U.S. government spent an additional $3.9 trillion. American firms and households invested an additional $3.6 trillion. Altogether, these expenditures totaled $21.5 trillion. Yet, American residents earned only $20.9 trillion in total incomes in 2020. The difference between what American residents earned and what they spent is approximately $600 billion. Now look back at Table 10.1. The balance on the trade goods and services plus statistically discrepancy is also approximately $600 billion. The two would match exactly if we used exact rather than rounded numbers. Hence, the American current account deficit equals the difference between the American income and the American expenditures in any given year. So this is what you got to understand. Literally, this final phrase, the current account deficit will equal the difference between the income and expenditures of any country. So it's saying, how is it that these countries, how can you spend more than you make? It's because you're probably spending money on goods, then you're bringing in the money from financial assets. Again, current account is more of goods and services. The financial account is like investments and bringing that in. So if you're spending money on goods and you spend more than you have, where did you get that money? If you don't have that money, there's like, what? That means you got it through an investment through your financial account. And then vice versa. If you spend less on goods and you actually make more money on the items you sell, you're probably sending out money and investing with the excess profits you have. I think it'll talk about that. But continuing, the United States can spend more than it earned in income because the rest of the world was willing to lend to American residents. The U.S. capital account surplus thus reflects the willingness of residents of other countries to finance American expenditures in excess of American income. If the rest of the world were unwilling to lend to American borrowers, the United States could not spend more than it earned in income. Thus, a country can have a current account deficit only if it has capital account surpluses. The same logic applies to a country with a current account surplus. Suppose we divide the world into two countries, the United States and the rest of the world. We know that the U.S. has a current account deficit with the rest of the world, and thus the rest of the world has a current account surplus with the U.S. If the United States can have a current account deficit only if the rest of the world lends the money to the U.S., then the rest of the world can have a current account surplus with the United States only if it lends money to American residents. If it does not, Americans can't buy as much of the rest of the world's goods. The rest of the world's current account surplus, as well as the American account deficit, then will disappear. Thus, a country with a current account surplus must have a capital account deficit. In terms of our income and expenditure framework, a current account surplus means that a country is spending less than it earns in income. The balance the country's savings is lent to the countries with current account deficits, and that's it. So we'll get into this a little bit more. It's going to start talking about balance of payments adjustments, but I do think this is like this whole lesson. I love it. Again, remember, if you don't forget, it's because we had a lot of volatility last week, but we were talking about currencies and exchange rates and the exchange rate systems and floated and fixed. Remember, we're understanding money and value, and it was talking about how every transaction determines the value of your dollar. So do you see why this is important here? You know, your payments and your trade, monitoring how much you buy and sell, that's to get the idea of the value of your currency and your goods. And that's why now this whole idea of capital account and current account, again, there's different types. There's real physical goods and labor created goods, and then there's services, and then again there's the investments. The capital account again is different than the current account. You know, think about it. We in America, people like our investments more than, they like our, hardworking manufacturing labor. That's a big difference. But the point here that we just went over, this is like where it gets mind-blowing, because like when you start to think about it, this way of like trade and, think about buying more than you actually have, this is what created, the consumerism we have in America. This is a lesson I've always given here. But the idea is that like, these countries like China and the guys who make all of our goods, they want us to be consumers. You got to think about it. They're the ones funding our behavior. If they didn't, we couldn't have this. So the fact that we buy so much, other countries, think about it. We buy more than we make. So we're buying and we're importing more goods than we sell. How in the world do we do that? Like it's saying, how can you spend more money than you're bringing in? If there was two countries and only two countries, that wouldn't work unless the country that is making the profit selling you the goods, they now have a surplus of the money coming in goods. So what do? They take that excess money and then they go and reinvest it into the country that's buying from them. They go buy our stocks, our bonds, and our stuff. Again, they invest through our capital account while we start investing and buying through our current account. So long story short, though, all of these companies pretty much fund our consumerism, and it's a pretty wild cycle that we've created here throughout the years. But we're going to get more into it, talk about the balances and all of that. But Chad, that is your Watch Us, ladies and gentlemen. Make sure Hydra Healthy ready to go. Make sure post your Watch Us. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, bro, you know the language. You know what I'm saying? You know it. Your face should be on the billboard. You know what I'm saying? You got this, baby. Nothing wrong with you. Let's make the most of it, Chad. I'll see you in the morning. Have a wonderful sleep. I hope you had a good weekend. And